Good evening, everyone. I'm CA Abhishek Damne, moderator for the webinar. I'm delighted to welcome you to this webinar, which is being organized by Committee for Commercial Law, Economic Advisory and NPO Cooperative Committee of ICI. So I heartily welcome our speaker, CA Manas, Advocate Manas Chu. Thank you, Manas, for giving your valuable time to the institute. So, in a short while, we will start with the seminar. But before that, I would like to take this opportunity to appraise you with the initiatives of the Committee for Corporate Laws Committee. So this committee is mainly focused on encouraging chartered accountants to shape the strategy and policy with to unlock the economic and financial as well as the social value while combining the analytical foresights with the commercial acumen. One of the core areas of this committee is to serve multifunctional task of analysis of knowledge dissemination, input to the regulators on various policy formulation to develop the uh, and as well as the publish technical guides, background material to create the awareness for the professionals in and look for the opportunities in the area of commercial laws, economic advisory, and NPO cooperatives. So today's session will be taken on import and export transaction under FEMA, which will be taken by CA Manas, who is uh, with us today. So he will be also taking us through the various provisions of import and export under transactions under FEMA. So before that, what are the current import and export of India? So I was just looking into the same. So when I looked into the same, that it is now currently India is the 17th largest country who is exporting. Now the exports are uh, around 776 billion US dollars, and whereas the imports are 854.80 billion dollars. When we have moved from the 17th position to 15th position in the year 2023, as well as we are exporting to 115 countries overall in this entire world. So it is fascinating that this tremendous export is being done by Indian entrepreneurs, which is into merchandise as well as into services. So, so who will help to guide our clients? What are the compliances under FEMA when we do the import and export? What are the nuances to that? So to help us with that, we have CA Manas Chu, who is an eminent faculty. I would like to take this opportunity to briefly introduce CA Manas. He is a chartered accountant and is a economic graduate from Delhi University. He was earlier with Deloitte Huskins and Sales. Now he is leading a consulting firm and advising clients with economic and taxation laws. He is mainly working into FEMA, that is Foreign Exchange Management Act. He also looks into foreign trade policy, specializes into SEZ, customs, as well as the GST thing, and anti-dumping and other various economic laws. He has served a lot of multinational companies, shaping and mapping their strategies for investment and compliance with the FEMA. He is also he has also assisted multinational for developing cost-based benefit analysis, focusing on the bilateral trade and the Karo-Tar rules. In-depth knowledge of his has helped Fortune 500 companies as well as listed companies, and a lot of such companies have benefited, and he has consulted them in FTP. His deep understanding about the international taxation, the trade and taxation laws has led him to present corporate advanced ruling relating to the customs and the various other areas of Custom Act. So we have an eminent speaker who is a fellow member of the institute. He has been on various committees of Export Promotion Council. He has also been on a lot of news channels and the professional institution and the PhD Chamber of Commerce. He has been a speaker, and he is also a regular writer in the newspaper as well as ICI journals. So I would like to take this opportunity to welcome Manas to this seminar. I'm sure members are looking forward for your inputs on import and export transactions under FEMA. So I hand it over to you, and I'll see you on the other side in the question answer session.
Thank you, Abhishek ji, for this elaborative introduction of mine. First of all, I want to thank the Committee on Commercial Laws, Economic Advisory and NPO Cooperative, for organizing this kind of webinar and inviting me on this special occasion. I would like to thank the Chairman and Vice Chairman Chitleji and Prakash Sharma for organizing these webinars and making the members of the profession aware of the specific economic and advisory laws and commercial laws which are impacting the business community. I must appreciate the efforts undertaken by Chitleji and Prakash Sharma in making sure and to make sure that the members in general and members is get aware of all the economic and commercial laws which plays a very important role when they are advising their clients, specifically because generally what in general sense the CA, when we talk about chartered accountants, everyone sees them as a start auditor or their tax advisory partner. But when we provide or when we see like from a very comprehensive or a holistic angle, we are basically CAs are basically a business solution provider. So until unless we don't provide each and every, we as an organization or I as a part of a firm cannot provide everything in a single umbrella, the client also doesn't feel certain kind of confidence. So this committee is making sure all the commercial and economic laws, which plays a very important role in building India to a developed nation and reach a $5 trillion economy, what all specific changes which the government is making sure in these specific laws, this specific committee is making sure all the CAs in general are aware of these specific laws so that they are able to give the charge and provide the services to the clients. So the today's topic of discussion is also a very important discussion on the international trade regulation. When I was discussing with Chitleji about this specific topic, he and I both elaborated on why this specific topic called as on the laws related to the international trade is also the government's focus in today's arena. The reason is simple. Earlier, I'll just brief it out on what was my specific discussion with Chitleji and why this program was led into. A brief history on India too. So India's economic history is majorly led through our own consumption. 70% of our total economy, our total GDP is on our total consumption, is our own consumption, like India's own consumption. So this was like before 1992, like if I talk about 1980s arena, it was not a socialistic economy, but a very inward looking economy. Inward looking means we were used to think about like whatever we are producing, that is sufficient for India. We don't need to have any kind of export or import. Whatever India is producing, India will be consuming. It was all on quota system because there was crunches. There was huge issue on the demand side, huge issue on the supply side. So that is why a quota system was led. So before 1992 arena, if I talk about 1975 to 1985 or 1990, it was huge issue on the India's economic side. In 1992, there was a huge change, and the change was all on the liberalization and globalization. What actually happened? There was a huge crunch. There was a difficult phase for the Indian government where whatever obligation they had on the export, not on the basically export, but on the loans that they have taken. So all the interest as well as the loan repayment they had, the obligation they had on the capital account side, the government didn't have certain kind of foreign exchange reserves. Our reserves are only limited to 14 days of reserves. The obligation Indian government had on the external debt that they have taken they didn't have sufficient funds to pay that. So because of this, government had the only single option to go to World Bank and IMF for external borrowings again, to pay at least whatever the duty, whatever the obligation they had. So ultimately they wanted loan to pay a different loan. So this was the situation Indian government was facing in around 1991, 1992. World Bank and IMF laid a specific condition. Without this specific condition, the government, the World Bank and IMF won't be giving any kind of loan to the Indian government. And the condition was that India has to liberalize and globalize. Liberalize on their internal as well as external policies and look towards a globalization environment. So this led to the major changes in our economic laws. The major change that happened was introduction of FTDRA Act, that is Foreign Trade Development and Regulation Act. That happened in 1992. Next act that was introduction was, there was change. Earlier it was FERA, Foreign Exchange Regulation Act. Foreign exchange, basically everything was regulated. But what the change was made was, it led to that there was introduction of change in the act from FEMA to basically FERA to FEMA Act. It happened in 1999. Then there was introduction of SEZ Act 2005. There was introduction of EOU. Earlier there was a concept of EPZ. The concept was changed to EOU. Introduction of foreign trade policy. So there were numerous changes in the economic laws, which led to the development of India. The reason was, until and unless we don't face the competition from the foreign manufacturers, we in India cannot even build that basically capacity and capability. Ultimately, what used to happen was, everything, the consumption, the dependency, everything was internal. So we were totally apart, we were not even disconnected from the world. To be connected to the world and look towards one world, one market, there was India signed the WTO agreement in 1995. All the amendments, all the acts which the government of India is coming up, they are aligning the WTO objective. WTO objective is simple: one world, one market. As there was introduction of GST, the laws or the objective was simple: one India, that is one nation, one tax. Likewise, the WTO objective is simple: one world, one market. So India has to be part of the world. Otherwise, what will happen? India will be disconnected from the world. Our own consumption itself cannot help us to grow into a developed nation. So that is why there were numerous changes in the international trade. So as I mentioned, what all were the introduction of different laws. I will not take into details what all these specific regulations talks about, how a chartered accountant can play a very big role in assisting and advising clients in the specific regulations. And also during different audit, when a chartered accountant does an audit, these regulations are not taken into much details, because of which they can lead to many kind of discrepancies in the audit financial statements too. So I'll make sure that what all the important regulations are there, I'll be briefing it out in today's session. And I would request each and every participant to, during the session itself, you can mention in the chat box whatever queries or anything you have in your mind. I'll be taking that during that time itself, rather than taking it at the end of session. I want the session to be an interactive one. So whatever questions, queries you have during the session itself, you can ask at that time. I'll make sure I'll be clarifying to your queries at that time, at that instance itself. So the first para or the first PPT talks about our India's export or foreign trade. So as I was mentioning, how the Indian government opened up its economy, why was the Indian government resistant in opening up its economy? The reason was simple: they want to safeguard the domestic manufacturers. So while safeguarding the domestic manufacturers, there were different issues which the Indian government was facing, because they were not able to grow at a faster pace. So because everyone was expecting when the government will be opening up the economy, there will be huge influx of imports. And because the Indian economy is still not resilient, or if I talk about still not capable enough during 1992 phase, So we cannot compete with these foreign manufacturers, and also we cannot even think about going for exports. So, but the government thought of a very long-term plan that eventually our exports will be more than imports. But in today's scenario also, our import is more than exports. That is, our trade deficit is still on the rise. The reason is simple. Our import is always greater than exports, and our imports are increasing at a faster pace than our exports. So why is this happening? Why is our import is increasing at a faster pace than our exports? For that, we have to analyze what all are the products that we are importing. These are the products that we are importing. First is the crude oil, that is 15% accounts for the crude oil, 7% accounts for the gold, 6% accounts for petroleum products, pearl precious stones account for 5%. So if I talk about of the top 4 products, 15 plus 7, 22 plus 5, 27 plus 5, 32 or 33% of our total imports is the products which we as an Indian or as a government cannot even produce. We as an Indian, or because of the geographical issues, we don't have the crude oil reserves. We cannot have the gold reserves. We are dependent on the petroleum products to a certain extent. Same applies to the pearl precious stones. So 32 to 35% of our total imports are the commodities which India can never produce. So this is the major concern which the Indian government is facing. Out of 35%, the 35% of the total imports will be always we will be dependent upon. So how the government can even look for or think about that our export will be more than imports? So the government has started thinking on how we can substitute these imports. The first, that is we call as crude as well as petroleum products, which in total covers 20%. The government is majorly focusing towards electric vehicle, because electric vehicle is the only way through which we can substitute this import of petroleum products as well as crude oil. Gold, India as a country or Indians are so much attached to the gold. So Indian government knows that we cannot detach Indians from the gold. So what they are doing is they are coming up with different schemes like SDBs. The government, rather than going towards physical acquisition of gold, government wants paper form of gold. So government wants that, because government is focusing towards exports, but we cannot, ultimately the trade deficit has to be converted into trade surplus. For that, we have to make sure that the import has to be, the products that we are importing has to be substituted with either the internal manufacturing or improving the capacity of the Indians. Next issue is we have to discuss on the export products. Anyone from the participants can just answer. So what do you think is a major product that we export from India? You can write in the chat box, what do you think is the major product that we export from India? And it is a very shocking product. Everyone says that agriculture, maybe textile. I've received one answer, garments. One is saying pearl and precious stones. One has mentioned steel industry. So the major product that we export from India is petroleum products. 15% of our total exports is petroleum products. It is surprising that we are the major importer of the crude oil and also the major exporter of petroleum products. 15% of our total exports is the petroleum products. So that is why we say Reliance, Indian Oil, HPCL, they have taken a big mark in the global market, because India is a very big player, or if we talk about, has a very good capacity on refining the crude oil. So petroleum products accounts for 15% of our total exports. Next is the pearl precious stone, that accounts for around 7%. Iron steel accounts for around 6%. Gold accounts for 2.74, that is at approximately 3%. So if I sum it up, around 30% of our total export is also the commodities which are basically not dependent on our own capacity or our own capability, but are dependent upon the internationally traded price. Petroleum products, pearl precious stones, iron, steel, gold, these four products are the products with which India's capacity is not majorly governed through, but also these are the products which are basically dependent upon the international traded price. So when we talk about when the government is formulating the export strategy, they know that 30% of our total exports are the products which is dependent on the international traded price. If the iron steel prices increases, automatically our export is increasing, but the quantity is not increasing. The price is increasing. So likewise, if the gold price is increasing, automatically what will happen is the jewelry product, the price, because of the automatic increase in the gold, the jewelry price will also increase. So our quantity is not increasing, the price is increasing. So what the Indian government, when they are evaluating, they have to verify, they have to see how the capability of the Indian exporters increase. So they have to also analyze how the export basket also diversify. We should not be dependent on these specific products. It should be that we have to be dependent. We don't have to be dependent on the specific products, for example, top 10 products. So these top 10 products which are coming on the screen, they account for more than 45% of our total exports. So we have to see how we don't depend on these specific products, but like diversify our export basket. So now we'll come to the topic of discussion, that is the international trade regulations and the current international trends which is coming up. So as I was mentioning on the exports and the imports, the international trade basically, what all the government thought process should be, what the government is thinking about. So the major objective, as I was mentioning earlier, the government was the current government was little resistive, or if I talk about certain kind of risk averse situation was there, they want to develop the domestic market. So that is why they were also resistant in opening up the economy as a whole. But when they were thinking of this, of formulating the strategy, there were different hurdles. Because of these hurdles, and the hurdle was simple. This specific graph is showcasing the hurdle. Our export from 2011 to 2021 or 20 was ranging from $300 billion only. Our total exports in the last 10 years, even after the Indian government, the export, basically the GDP is increasing around 7-8%, our total export wasn't increasing. Our total export was ranging around $300 billion mark only. So there was huge difficulty from the government perspective, because the government thought of the strategy, it was not totally not going in the favor. So the government has started looking towards a different strategy as a whole in the current scenario. And what strategy is the government is formulating? First and foremost strategy is the signing of the trade agreement. So trade agreements, as in the case of taxation, the DTAA, trade agreements are signed between either two countries or signed between multiple countries as a whole. And the objective of this trade agreement is to increase the market access. So how the government increases the market access? First is reduction in the custom duty. For example, the last trade agreement which was signed was with Australia and UAE. So with Australia and UAE, if I talk about, the objective was simple, the increase the international trade. That it like India cannot like formulating the strategy, the Indian cannot only focus towards increasing the exports. Obviously, they have to also open up the economy as a whole for the specific country with which they are signing the trade agreement. So while signing the trade agreement, obviously the Indian government is opening up the economy. So what they will be doing is they will be giving certain kind of advantage by reducing the custom duty when the specific product is exported or being produced or being sold from that specific country. So when a particular product, for example, any product comes from Australia to India, it is imported at a reduced custom duty or a 0% custom duty. Likewise, if I talk about there are different trade agreements which the Indian government has signed. The latest one was signed with SEPA. So the latest one was signed with 4 countries from the basically Europe continent. And the objective of the Europe trade agreement, which was signed, was it was signed with Switzerland and 3 other countries with India. That is EFTA agreement. So the objective of this trade agreement was also simple: to open up the economy. But the thought process was totally different. If I talk about what the thought process was, I'll just give a brief detail about it. So if I talk about a Switzerland, Switzerland economy is already very open economy. 99% of the total, basically not 99, 99, but 9% of the total imports into Switzerland is imported at a 0% custom duty. There is 0% custom duty in Switzerland. But the EFTA, if I talk about the latest trade agreement which the Indian government has signed, they have signed with this EFTA countries and India. So EFTA countries include Switzerland. So when they're signing the trade agreement with Switzerland, the government knows that they can export to Switzerland at a 0% custom duty even if without signing the trade agreement. So why they have signed the trade agreement with Switzerland? The objective is totally different from the Indian government. The objective is when the trade agreement is signed, there is a specific clause in the trade agreement. And the clause in the trade agreement talks about there is a specific clause on the investment. This specific 4 countries have mentioned that there is a commitment on the investment. In the next 10 years, $100 billion commitment is given by these EFTA countries to India. For giving this investment commitment, the government has opened up the economy and provided different kind of concession in the import duty when the product is exported from these countries into India. So the simple objective is to give the market access, to increase the investment, and also to make sure whatever mutual recognition is possible between the countries is also included in the trade agreement. The latest trade agreement which the Indian government is planning to sign is with UK, United Kingdom. It is still under discussion. There are different hurdles which are coming. I'll be discussing the hurdles in the future when if we have the time. So it is expected after this election, when the new government is formed, the trade agreement with the UK will be signed. So the first and foremost emerging trend that is happening is in the trade agreements. Second is the rule of origin, stricter rules of origin. I will be discussing in details. Third is the trade facilitations. That means the government is moving towards the ease of doing business. So the government is giving different kind of facilitation to the exporters and importer community. The government is reducing the benefits which are available under the foreign trade policy. The government is giving different kind of incentives like PLI, specs, and other incentives which are not dependent on the exports. The government is thinking about diversifying the supply chain. So, for example, China Plus One strategy is implemented. So the simple objective is to give the market access, to improve the marketability of the Indian products, to produce basically a quality product into India. Also, the major trend also is happening is increase in the quality products, increase in the quality regulations. So what the government is doing is they are coming up with barriers. These are called as non-tariff barriers. That is, it is not increasing in the tariff, but coming up with different kind of non-tariff issues. For example, coming up with either restrictions in the import of product, coming up with either like incorporating a quality standards like BIS, ISO, EPR regulations. So this is also major trend which is coming up in the international trade. So now we will be discussing on the regulation side. So these are the regulations which are governs the international trade. First is the FTDRA Act. Second is FEMA Act. Third is FTP Act. Fourth is SEZ Act. So these 4 acts are the economic laws. That is, they are regulating the international trade. Customs Act and GST Act. These 2 acts are basically governed from the revenue angle. That means revenue from the government perspective means that they are earning certain kind of tax benefit from them, tax out of the importer and exporter community. So these 2 acts are from the revenue angle, other 4 acts are from the economic angle. So first and foremost thing is understanding the definition of exports. Definition of exports is majorly similar in all the 4 laws. So if I brief it out, export is basically taking out of India goods or services to a place outside India. That means I'm taking some certain kind of goods or services out of India to a place outside India. why the government or the act specifies to a place outside India when it is already specified that means taking out of India. The reason is there are certain kind of specific jurisdictions in India which is also termed as foreign jurisdictions, like gift city, like SEZ, like EOU. So these are certain kind of areas in the jurisdiction, in basically geographical areas of India, which are called as foreign jurisdictions. So the Custom Act or all the four acts clearly specifies that taking out of India to a place outside India. So until unless they don't cross the boundaries of India, it will not be termed as exports. Any questions till now? You can ask during the like in the chat box itself. So what all are the general laws when we understand the international trade or the exports and imports? The exports and imports are governed through or regulated through three policies, or the products are classified under three policies. One is free category. For free category means 99% of our total imports or exports falls under the free category. Free category means you can import and export or the specific product or goods without any permission, restrictions, regulations from the government of India. That means you don't have to take any permission or regulation or permission from the government of India like before exporting or importing. So 99% of our total export or import falls under the free category. Second is prohibition. Prohibition means you cannot import or export. Even after taking the permission from the government of India, you cannot import or export. Third is restricted. Restricted means you can import or export the specific product, but with the permission from the government of India. Without taking the permission from the government of India, you cannot import or export. Restrictions, if I talk about in the current scenario, the different products which falls under the restricted category, different numerous products. Because I was mentioning the government in the current government, they want to safeguard the domestic manufacturers. They're looking for substituting the import products. So what they're doing is they're coming up with restrictions on the import. Restriction means, for example, the latest restriction was on the laptops. If I want to import laptops into India, I have to take the permission from the government of India, that is the DGFT, Director General of Foreign Trade, which is part of the Ministry of Commerce, and the concerned ministry's NOC. First, I will take the NOC of the concerned ministry. Then, the Ministry of Commerce through the DGFT will be allowing me or giving me an authorization to import or export the specific product. So there are numerous products that fall in the restricted category, like laptops, gases, the HFC, like hydrofluorocarbon gases, which is used in refrigerants or refrigerators or ACs. Tires are under the restricted category. TV is under restricted category. AC is also under restricted category. There are numerous products which fall under the restricted category. So when a product falls under the restricted category, we have to take the permission from the concerned ministry, that is the DGFT, and the NOC from the concerned department. So here the role of the chartered accountant or profession comes, where you have to represent to the government of India on why the permission or the authorization has to be given to you. What special you are to give you the permission to import the specific product. So this is the responsibility of the basically the consultant or basically the professionals to represent the government on and allow and approach the government of India to obtain the authorization from them. Fourth is the state trading enterprises. So state trading enterprises means the product can be dealt only with the state trading enterprises. Can be dealt only with the PSU or certain kind of companies which is governed or which is regulated by the government of India. So four policies. One is free category, prohibited, restricted, and exclusive trading through the state trading enterprises. So these are the four categories under which all the products falls into. Next is IEC. When we are importing or exporting, the first and foremost number that we have to take is IEC number. That is importer exporter number. Importer exporter number is equivalent to a PAN number, but you have to apply to the government of India before undertaking import and export. So when you are importing or planning to import or export, I have to take the IC number, without which I cannot import and export. Third is the RCMC. RCMC means when I'm taking any kind of incentive from the government of India, I have to take the membership from the concerned ministry. Concerned ministry, not concerned ministry, basically concerned export promotion council. So specific to the product, there is a specific export promotion council. For example, for garment sector, there is AEPC, that is Apparel Export Promotion Council. For example, accountants like us, there is a promotion council called SEPC, that is Service Export Promotion Council. So for individual all the products, there is a specific export promotion council. For example, engineering, there is Engineering Export Promotion Council, and also General Export Promotion Council called as FEO. If a product is not falling under any of the category under the Export Promotion Council, you can take the membership from the FEO. These are the products which are mandatory under the mandatory documents for the import and export. I won't be going much into detail. Now the next question is, when I'm exporting or importing, what should be the denomination of my contract? That means the export and import contract, what has to be my denomination? Can it be in the Indian rupees? Can it be only in the freely convertible currency? Can it be in any currency which is permitted or which can be permitted by the RBI or which is permitted by the World Bank? So the policy, that is the FEMA Act, clearly specifies that our export and import contracts can be in any currency, be it INR for freely convertible currency or any currency. But the realization has to be only in freely convertible currency. The realization has to be only in freely convertible currency. But my export contract or invoice can be in any currency. So the next question to all the participants is, what according to you is a freely convertible currency? What do you think according to you is a freely convertible currency? I receive one answer, dollars. Another answer, Australian dollars, yen, pounds. So yes, so basically the government, basically the RBI, any other FEMA Act or any act doesn't specify what are the freely convertible currency, but the IMF has clearly specified 5 currencies, that is dollars, euro, pound, yen, and Chinese renminbi. So these are the 5 currencies which are termed under the freely convertible currency. So what we can do is, for example, if I've exported a product, I can get the remittance only in this specific freely convertible currency, but my invoice or contract can be in any currency. But there is a recent change in the regulation, and this change came in the last year. What exactly was the change? There was a very important change by introduction of APDR circular number 10. APDR circular are basically the circulars issued by the RBI for the references for the AD bank. It is not for in general as a like entity or individual like us. It is for the reference for the implementation by the AD bank. So APDR circular 10 was introduced by the RBI, and it was a very important and big change which was introduced. The bigger change was the invoicing, which used to happen in the Indian rupees, continues. The major change that happened was the settlement can also happen in the Indian rupees. That means our import and export transaction can also happen in the contract, can happen in Indian rupees, but a settlement can also happen in the Indian rupees. So this was the major and big change which the government of India had introduced. But there is a small catch. What exactly is the catch? The catch is the settlement can happen in Indian rupees, but the settlement can happen only with selected banks, only with selected countries. It cannot happen with all the banks. It cannot happen with any other country. It is only with selected banks and only with selected countries. So the RBI has to give the permission to the specific country and the bank. Then only the transaction can happen in the Indian rupees. So the government of India is looking towards internationalization of Indian rupees. So for that, they have taken the first step. So for example, the Russian country has some, so what basically the regulation is, the Russian bank has to open an account with the Indian bank. That is called as Vostro account. So through that Vostro account itself, the routing of the funds or basically settlement will happen. So for example, for example, I've sold certain kind of product to Russia. I've exported the product, for example, for 1 crore rupees. I can directly send 1 crore rupees to the Indian Vostro account of the Bank of Russia. And basically the Russian bank, which has a presence in India as a Vostro account, will accept it and will issue me a BRC, that is called as Bank Relation Certificate. This is very much compliant with the FEMA. You don't have to take a permission, or you don't have to settle specifically with the under the freely convertible currency. You can settle it in the Indian rupees. But the condition is simple. It can happen only with selected banks, only with selected countries. It is not a general thing that if I specifically am exporting to UAE, I can settle in Indian rupees. It is not possible. You have to do it only with the selected country as well as selected banks. Any questions by anyone? You can ask during the chat box. You can ask in the chat box itself. Just give me a moment. So as I was mentioning, the settlement can happen in the Indian rupees. So there is a specific, the regulation also elaborates on how the advances against exports will happen, how the setting of the export receivables will happen, how the rupee surplus balance will be undertaken. I won't be going much into detail because it is not the topic of discussion for the today's session. Next is the realization period. So what exactly is the realization period? When I'm exporting from India, that is, I'm undertaking an export activity from India, I have to realize within the 9 months time period. That is, when I'm exporting, from the date of export, I have to realize the amount within the 9 months time period. What if I'm not realizing within the 9 months time period? I have to approach the RBI for the extension. And the bank or the RBI, basically not the RBI, basically the bank, I have to approach the bank for the extension. And the bank will give me an extension for 6 months at a time. And there is no specific limit. For example, there is no limit that you have to realize within 3 years, 5 years, or 7 years. There is no end limit on what the end limit, but you have to apply it for 6 months at a time. While applying for the extension, you have to give a proper justification on why you are planning to go for extension. Why the specific country or why the specific, basically the buyer is not giving the realization for the exports. So you have to give a valid justification. What are the steps that you have taken for the realization? Have you filed any Have you filed any kind of court case against the specific buyer? So these are the specific things that the bank will take from you. Then only they will give an extension for a 6 months time frame at a time. Next is, for example, the next regulation talks about for the warehouse. So for example, when I'm exporting to a warehouse, what exactly is the warehouse? So warehouse doesn't mean, for example, I'm exporting to Amazon warehouse outside India. It is not the case. Warehouse means warehouse which are set up by the Indian person in that specific country. So can I also open a warehouse across across world, anywhere across the world? Yes, I can do it. But there is a specific condition on who can open a warehouse outside India. So I will not go much into detail with the specific thing on the or maybe I will be going much into detail on what all are the specific regulation on the warehousing side in the future slides. Next is the advance payment. So what exactly talks about the advance payment? So for example, I want to undertake exports, but before that, I have given a specific condition that I need 25% advance, then only I will be starting towards the exports. So if for this specifically, this is possible. Clearly, if I talk about domestically, there is no condition, there is no issue on whether within how much time frame you have to export, but you have to sell in the domestic market. But there is a specific condition in the FEMA Act. FEMA Act specifies when you have received advance payment, you have to export it in 1 year time frame. That means, for example, I have received advance today. I have to export. I have to make the shipment of goods within the 1 year time frame from the date of receipt of the advance. If I'm not able to do it within a 1 year time frame, and eventually the bank, or basically the buyer started mentioning that you don't export now, give back my advance after the 1 year time period, it is not possible. When basically you have export, when you have received an advance, but within 1 year you have to export. Within 1 year you're not able to export, you can export it in the additional time frame with the permission, with the specific permission, not from the RBI, but you have to approach the bank. But for example, after 1 year, you're not even if you're not able to export and you want to give back the money back to the buyer, then in that case you have to take the specific approval from the RBI. So I hope it is clear to all. 9 months is the time frame to realize. 15 months is the time frame for the realization from in the case of warehouse. So when do you think the warehouse why the 15 months time frame is given, or when this warehouse capacity will be used? Anyone? So basically, why this warehouse capacity is used is, if I talk about, there are different, for example, if I talk about my personal experience, we have multiple clients who are into the e-commerce facility. So what they do is they don't want to export individual product, because it would be a costly affair that the transit cost is more than the product value. So what they do is they generally store their whole products in a warehouse outside India, use that warehouse. Whenever whenever order comes directly from that warehouse, the shipment is sent to the buyer. The issue is because the warehouse is made to make sure everything is streamlined, a liberalized form is made. So that is why the government has thought of giving an extra time of 6 months, additional time of 6 months. So they have given a 15 months time frame, that if you are exporting to a warehouse outside India, you can do it, you can realize within the 15 months time frame. So as I was mentioning on the extension time is simple. You can extend it for 6 months at a time. 6 months at a time. And there is no upper limit. That means you have to realize in 3 years, 5 years, or 10 years. 6 months at a time is the maximum limit. 6 months at a time is the limit. But there is no end limit. So, but when we are going for the extension, you have to give a proper justification. So the justification also specifies that there is no investigation by the enforcement or the director, that is ED. There shouldn't be any kind of investigation by CBI or RE or any kind of investigation agencies. Or there will be specific conditions which is attached to it. If you're fulfilling these conditions, then only the government will be, or the bank will be giving you an extension. If you're not, then you have to somehow get the realization, otherwise face certain kind of penalties from the RBI. Next is the third party payment. So what exactly is third party payment? In the case of India, for example, if everyone has heard about bill to ship to model. For example, I've billed to someone, I've shipped to someone. That means I'm billing to, for example, someone else. I'm shipping it to someone else. So I'm getting the realization from the person I'm billing to, but on the request of the specific buyer, or basically the person to whom I have billed, he is mentioning that rather than sending the products to him, send the product to the specific person or the consumer directly. So that is called as a bill to ship to model. Here in the international trade, bill to ship to model is not simple as in case of GST. In the case of GST, the regulation is very simple. But here in the case of FEMA Act, it is not simple. Because the reason is simple. The objective is you have to, the person to whom you are exporting, he should be the only person to remit the funds to you. When there is certain kind of routing of the funds, for example, you have sold to an African country which doesn't even have the foreign exchange reserves, but the funds is routed through UAE. So that is a concern from the government. Concerns from the government perspective. The different kind of hawala transaction that is happening. So these are a lot of the conditions or the concerns which the government of India is facing. So that is why the government has straight away mentioned a third party payment. So what exactly is the third party payment regulations? Third party payment regulation mentions that you can do it. That means you can export to someone, but get the remittance from someone else. This is possible. But there are different checks. checks and balance by the government, checks and balance by the RBI. What all are the checks? First is there has to be a tri-party agreement between the three parties, that is the seller, the buyer, and from the person who will be giving the remittance. There has to be a tri-party agreement. AD bank should note that the transaction seems to be a bona fide transaction. Now the question arises, what exactly constitutes a bona fide transaction? So that is the major ambiguity and the major issues that the bank faces, and the bank rejects these kind of applications because bank straight away says that third party payment, the transaction is straight away with a different objective. It is not with a bona fide objective but a mala-fide objective. So the bank, because the RBI regulation, it's a very broad regulation that it is the responsibility of the AD bank that he should be satisfied that it is a bona fide transaction. So it is a responsibility of the exporter to prove how this specific transaction is a bona fide transaction. Next is the AD bank should consider the FATF statements while handling such transactions. Single bank challenge has to be routed through. EDF form has to be made. It will be responsibility of the exporter to realize and repatriate the export proceeds from such third party named in the EDF. The reporting of the outstanding has to be done by the AD bank and different other specific regulations. So if I am undertaking a third party payment regulations, if I am undertaking a third party payment, that means I've exported to someone, I'm getting the realization from someone. This is straight away possible, but you have to clearly fulfill these specific conditions. Ultimately, there has to be a bona fide intention while undertaking this transaction. It shouldn't be any routing of funds. It shouldn't be that the funds is just routed through maybe UAE or different tax haven countries. It should be from a country to or the person to whom you have exported to. If not, it has to be governed through or it has to comply with the specific regulation. So anyone has any questions till now, you can ask me. Or otherwise, I'll move to the next part. Next is write-off of the unrealized export invoices. So what exactly is this? It is basically write-off of the unrealized export invoices means, so when I'm selling it in the domestic market, there are different issues. Issues is, that means, for example, there is a quality concern. Basically the person to whom I've sold to is not satisfied with what I've sold. It is either the quantity, quality, or different hurdles or issues which the buyer is facing. So what they do is they either issue a credit note or debit note. Credit note is a very common concern or very common document which is being issued in the domestic selling or domestic market. But in the case of export and import, the issue is very different. Because here, why the specific thought process is different here is, here the objective is not only to export. The whole transaction will be completed when you get the realization. Until I'm not getting the realization, what is the process? What is this? Like ultimately, the objective is not completed. So that is why, until I'm not getting the realization, the whole transaction is not completed. So that is why when I'm talking about the export and imports, there is a very difficult the whole interpretation or regulation has to be taken into consideration. So when I've exported to, for example, I've exported a certain product to, for example, USA of amounting to, for example, $1 million. When I've exported a product, a part of the shipment, the buyer has realized that it is not fulfilling the criteria or not fulfilling the criteria of the quality of the product which he was expecting. So straight away what he'll be saying is, I will be not giving the money to you. So I, as an exporter, I'm totally worried. Like how now I will be proceeding? I've exported the product. I'm not getting the remittance. Shall I just issue a credit note and it will be sufficient enough? Will it suffice the purpose of the FEMA Act, GST Act, and different acts which governs the international trade? It is not the case. When I'm exporting, I have to make sure, and when I'm exporting and I have to undertake a write-off, there is a specific limit which is attached to it. Limit is 5% of the total export proceeds realized in the previous calendar year, not financial year, but calendar year. So total export proceeds realized during the preceding calendar year. 5% of it I can realize on my own. 10% I can realize it if I have the stakeholder certificate. 10% I can realize it with the permission from the AD bank. If I have to write off more than 10%, then in that case, I have to take the permission from the RBI. So basically the regulation is simple. 5% of the total export proceeds. Proceeds means export realization. It is not export, but export realization. 5% of the total export realization in the preceding calendar year. I can do it on my own as a own. 10% I can do it but with the permission of the AD bank. Above that, I have to take the permission from the RBI. Now the next question arises for the first 5%, and it is not like first 5% AD bank and next 10% like first 5% self and next 10% AD bank. It is not the case. 5% total AD bank, 5% total self, 10% total AD bank. So for example, if I have to write off 8% of the total export proceeds in the current financial year or in the current calendar year, I have to straight away take the permission from the AD bank. It is not that for the first 5%, it is not that for the first 5% I can do it on my own, and next I can do it with the permission of the AD bank. It is not the case. So as I've clearly specified, for that first 10%, totally I have to take the permission with the AD bank. Just give me a second. So basically, for 5%, I can do it on my own. For 10%, I can do it with the permission from the AD bank. But the next question that arises is, can I do it on my own? That is, first 5%, can I do it on my own? That is, I don't have to inform bank, RBI, or anyone. No. I have to inform the bank. There is a specific software called as EDPMS software, which is basically customs and RBI mutually developed software. I cannot access it. It can only accessed by the bank as well as the customs. When I'm exporting, I have to file a shipping bill. According to the shipping bill, automatically what will happen is it will reflect in the EDPMS system. From that EDPMS system, when I'm getting the realization, I have to take all the documents with the bank. That is, I have to get the receipt. I have to take the receipt with the bank that I've realized this specific receipt in reference to this shipping bill. So what the bank will do is bank will knock up the EDPMS entry. So when, for example, I've exported $1 million of product. I've realized, for example, $95,000. I straight away, what I'll do is I'll just write it off in my books of accounts. And what I'll do is I'll just write it off and won't inform any bank or something. What will happen? Automatically in the EDPMS system, it will straight away reflect that 5,000 is a pending entry. The entry will remain pending. That means you exported for $1 million, but you have realized of a lesser amount. So that is why the EDPMS system will straight away say there will be straight away in the EDPMS system there will be a pending entry. This will be a major cause of concern for an exporter like me. So what I have to do is I have to approach the bank. I have to approach the bank and say that for this specific export, I have realized this much amount itself, which is falling under the 5% category. Just allow me to write off. So bank will allow you to write off. So accordingly, what bank will do is bank will also write off in the EDPMS system. Bank can ask certain kind of questions from the exporter that why are you writing off? Is there any issue on the quality? Bank can also ask for the CA certificate. So there are different procedural things which comes into play when you are going for the write-off. Within 10%, AD bank is allowed. Above 10%, you can do it, but with the permission from the RBI. Any questions or queries anyone has, you can just mention in the chat box itself. So these are basically the documents which are required. The documents clearly specifies. Just give me a second. So the documents clearly specifies that it has should remain remained outstanding for more than 1 year. There has to be sufficient documentary evidences to prove that you have taken full efforts to realize that amount. And for example, there can be a possibility that the overseas buyer has declared insolvent, and Indian embassy is involved in getting the realization, or the product is basically auctioned or destroyed within the port. So there are different ways, angles, or through which the write-off is undertaken. So when the write-off is undertaken, you have to give a documentary evidence. It is not like you approach the bank and say that you have to write off. You have to give a documentary evidence on why you are going for write-off. You have to give a satisfactory response to the AD bank. Then only the self write-off will be also given. And also, a CA certificate is required. Why a CA certificate is required? When we are approaching the bank for the write-off, when I'm exporting, the government of India has given me certain kind of export incentives. It can be road tax scheme, it can be due to drawback, or different schemes like advance authorization, or any of different schemes which the government has given to us when I'm exporting a product. So when I'm exporting a product, and the condition attached to different scheme is that you have to realize within the time frame which is allowed in the FEMA Act. So the next question that arises is that I've exported a product, I've realized it, but realization is part. So what the government has said is when you realize a part of it, then you have to give back the proportionate incentive which you have availed. So you have to give back to the government, to the customs, the proportionate expenses or the proportionate incentives which you have claimed, but you were not allowed to because you have not realized within the time frame which is allowed in the FEMA Act. So there a CA certificate is required by the AD bank, which clearly specifies that all the export incentives which were availed by the bank, availed by the customer, is being given back to the customs with interest. So there a CA certificate is given, providing a justification, yes, that the exporter has fulfilled the specific condition. Any questions till now, you can ask me. Next is reduction in invoice value. So what exactly is reduction in invoice value? Reduction in invoice value specifies, or it is seen in for example, companies like e-commerce companies, which I've also practically very much seen is the case. For example, I've exported a bulk shipment, but because it's an e-commerce, I don't have the buyer as of yet. I'm just exporting it to a warehouse outside India. So I don't have the buyer as of yet. I'm just exporting it. So what the concern happens is when I'm exporting, I am not getting the remittance. I'll be getting the remittance at the time when the product is being sold from that warehouse to the specific customer. So the customer can approach in a single day, approach in 5 days, 10 days, 1 month, 9 months, maybe a year, maybe 2 years, 3 years. And for example, if even after 1 year, you are not able to realize that amount, that specific shipment is of no use to me because the cost of returning back to India is more than the cost of the specific product. So what happens is I have to give certain kind of discounts to the buyers of that country. With that specific discounts, there can be a possibility of promotional discounts. There can be a possibility that I get certain, I can create certain kind of demand in that market and my product is being sold. So what the specific regulation specifies, it says that 25% of the invoice value you can go for a reduction. That for example, I've exported $1 lakh. 25% is the maximum cap I can give, or maximum discount I can give. When for example, because of either maybe quality concern, it can be because of the promotion discount to sell my product, any kind of discount you want to give, it can be promotional, quality, or anything, you can do it. 25% of it can be done as a reduction in the invoice. There are different other conditions that you have to follow. Like for example, you have exported, you have taken the export incentives, you have to give back to the government the export incentives. Other also, like the exporter should not be under the export caution rate. caution list. So different different regulations on this specific issues. Next is refund of the export proceeds. Refund of the export proceeds means I've got the remittance, I've exported, I've got the remittance also. But later on, what was found was that the product was poor in the quality. So in that case, the buyer said that I'll be exporting the product back to me. Because of the quality concern, poor quality, I won't be accepting your specific container. In that case, the government has clearly specified that you can refund back the export proceeds that you have received of your initial exports. But there are other conditions too. That the bank has to verify that it is a bona fide transaction. There is actually a movement of exports, movement of goods. It is not like I've exported, the receipt is being given, but now the buyer basically is saying that just misappropriate the funds to give back the funds back and settle the amount in certain kind of cash or different kind of other ways. What will, from the bank perspective is, or from the government perspective, there is a huge loss. The product doesn't reach India's border automatically. It is discarded by actually it is not discarded, it is with the buyer itself. But only the routing of fund has been happened. So here it is the responsibility of the AD bank to clearly say that how to verify basically how this transaction is a bona fide transaction. The responsibility is to mention and basically undertake a due diligence on the track record of the exporter, on the track record of the past export trends which the exporter has undertaken, bona fide transactions, obtain a certificate from the CA certificate, specifying on the export incentive which already has been availed to give back to the government. So these are the specific regulations when you have to refund back the export proceeds. Next is set off of export receivables and against import payables. This is a very important regulation, and the regulations clearly specify. Just give me a second. I'm joining in a minute. Just give me a second. So I was mentioning on the setup of export receivables against import payables, it specifies, for example, I'm dealing with a company which is either my holding company or a subsidiary company or any of the group companies. What I'm doing is I am exporting to that specific company, and I'm getting the realization also from I'm exporting to them, and also I'm importing from that specific country also. So what I'm doing is I'm doing both the activities, export and import, from the same company. In that case, what will happen for the exports? I have to get the remittance. For the imports, I have to make the remittance. Therefore, if I'm doing the same transactions, for example, within India, there is no concern. It is ultimately in my books of accounts entry that the export receivables and the payables are adjusted. Here, it cannot be, because as I mentioned, there is a EDPMS system. Likewise, in the case of import, it is IDPMS system. So here the concern is the EDPMS system entry will still be there, because ultimately you have knocked out that specific entry in the books of accounts, but it is not knocked off in the EDPMS and IDPMS system. So here you have to approach to the AD bank. You have to specify that in regard to this specific export transaction, I have also made to the specific company, I have also made an import transaction. And then in that case, my export and import transactions can be knocked off. So what the bank will do is, bank will ensure the genuinity and the bona fide of the transaction. A single bank has to be only there for the whole transaction of export and import. There shouldn't be any kind of ED case or a CBI case against the importer and basically the person to whom who are taking this specific transaction. The knockoff, basically it is set off. Set off can happen for the transactions of which happened in a particular calendar year. It cannot happen, for example, a transaction which just happened in, for example, 21-22, and another transaction which happens in 22-23. The both set of both the transactions are settled off. It is not the case. The specific transactions which are happening within the same calendar year can only be set off. So this is a very big concern. If you want to set off different calendar year entries or transactions, then in that case you have to approach to the RBI. Then only with the permission of the RBI you will be given a permission to set off of the export and imports. Next is softex forms. So softex forms are basically forms which is majorly, for example, when I'm exporting a particular product or a goods from India, I have to file a shipping bill. Shipping bill, it is very important. It's a very important document. So when I'm exporting from India, shipping bill is filed. When I'm filing the shipping bill, it is informed to the customs that this is a specific product I'm exporting. This is the value of the product I'm exporting, quantity and everything. The product of the product, that is it is about me. That is the KYC of the company, the details of the company, the details of the buyer, the details of the consignee, the details of the transporter, the details of the product, HSN code, and everything and anything related to the details is mentioned in the shipping bill. Now the next question arises, for a person like us who are into service exports, how will the government will be able to understand that I've exported my services from India? Is there any way the government will be able to identify how the services is exported from India to a country, for example, USA? Because the services, for example, is given by me or given by professionals like us. So the service is clearly given by professionals like us, but I have not informed any bank. I have not filed any kind of shipping bills to the customer or someone. It is just that I have raised a specific invoice, tax invoice, and automatically I have get the receipt. So in that case, what happens is when I'm getting the receipt from the bank will automatically say that why you have received this specific amount in the foreign exchange. For that specific entry, I have to approach the bank and mention to the bank that this specific transaction is pertaining to do this specific invoice. So knock off this specific transaction, because as soon as I'm getting the remittance, automatically it will be reflected in the EDPMS system, because it is basically either it can be import advance or it can be export or remittance. So automatically it will be reflected in the EDPMS or IDPMS system according to the transaction which you will be declaring to the bank. So when you have to then basically then you have to knock off that entry in the EDPMS and the IDPMS system. For that, you have to approach to the bank. You have to mention to the bank that this specific remittance was pertaining to this specific invoice. So service industry is totally not much regulated in terms of only single regulatory authorities there when they are regulating the exports or imports. So this is for general services. But the government cannot, because the government has to have certain kind of policies or regulations, which is there has to be a maker and checker rule. So that is why what they have done is, because IT export is a major export from India. So what they have done is they have started with the IT exports, and what the regulation they have is, for the IT exports, you have to file a softex form. Softex form has to be filed monthly with the concerned STBI or SZ, mentioning that this is the specific export invoices you have raised in the previous month. When you're realizing the amount, automatically you have to approach the bank again and mention that pertaining to this invoice, I have got this specific remittance. So only in the case of IT and IT related services, softex forms are filed. Otherwise, in any other case, there is no regulation or there is no specific issue on or there is no specific consideration on the export or import of services. Only in case of IT and IT services, IT related services, you have to file the soft text forms with the STPI. Now the next question arises, I'll just brief it out. In the case of STPI, there are two parts to it. STPI, I will be, for example, I'm registered, I'm based out of, for example, Delhi. I have my office, for example, in Lajpat Nagar. So in Lajpat Nagar, there is no specific STPI unit, like a SEZ unit, there is no STPI unit. So what I have to do is, being a person who has an office in Lajpat Nagar, I have to approach the STPI. I have to say to the STPI that I have to register myself as a non-STPI unit. After that, I have to start filing the soft text form with the STPI unit monthly. In the STPI form, in the soft text form, I have to specify what all are the export of services I have undertaken in the previous month, and accordingly, it will be reflected in my EDPMS system. EDPMS system will be knocked off when I am getting the remittance. So then only the whole complete chain will be formed and will be completed. I was mentioning on the warehouse abroad that 15 months is given the time frame when I'm exporting from India to a warehouse. This is the condition which is there when you are exporting to a warehouse outside India, who can basically open or hire a warehouse abroad. Next, we'll be discussing on the import angle. Import, just like export, the definition is similar. Is bringing into India from a place outside India. That means bringing into India from a place outside India. Another question that arises is, for example, it will be a question for all the participants. For example, there is a SEZ unit. In the SEZ unit, a particular product is sold to a domestic market. Do you think it's an import? When I'm getting the import remittance, when I'm getting the import of goods from, for example, USA, China, or any other country, it is straight away called as under Customs Act or all the 4 acts, it is straight away called as imports. But in the case of SEZ, when the product is sold from SEZ to DT unit, whether it will fall under the import category or not. In that case, it is also called as imports. So under which act it is called as imports? There is a specific act called as SEZ Act. Under the SEZ Act, it will be termed as imports. So when a particular product is sold from SEZ to DTA, import duty is to be levied on the finished product. It is not on the raw material, but on the finished product, the import duty has to be levied. It is on the basis of the Custom Act read with the SEZ Act. So what we were discussing on the export angle, 9 months is the time frame for the getting the realization of exports. I can extend it for 6 months at a time. In the case of exports to warehouse, I will be given additional time frame of total 15 months. Now next question is import provisions. Import provisions clearly specifies the policy is the same. All the importers falls in the four category. Import is free, prohibited, restricted, and state traded enterprises. It is same as we have discussed on the exports. But in the case of remittance, that is, for example, I've imported, within the 6 months time frame, I have to make the remittance. Within the 6 months time frame, I have to make the remittance. Then only it will be that is a time frame which is allowed by the RPI. Now, next question arises is on the extension. Extension is similar to the exports. Here the extension time frame is 6 months at a time, but maximum up to 3 years. That means I can extend the time frame for the import, but the maximum time frame, it will be 6 months at a time, but maximum time frame will be 3 years. Now the next question arises, how come the government, in the case of exports, there is no maximum time frame, but in the case of import, there is a time frame? Government objective should be to get the remittance. Government objective should be to get the foreign exchange earnings. But here the government is opposite thought process. Government is saying make the payment. Even if you not make the payment, take the extension. And the maximum extension they will be giving is 3 years. In the case of exports, there is no maximum extension time frame. Here the objective of the government is totally different. The government objective is with the thought process that if a particular import shipment remittance is not made, the recognition of not the specific, basically the buyer is halted or the buyer is at the stake, but it is the country's image. All the country's image will be at stake because the specific seller will be of the opinion that all the Indian buyers are the same. They don't make the payment in the like specific time frame, or they either don't make the payment. So that is why the government has clearly given a maximum time frame of 3 years in the case of imports. In the case of exports, there is no maximum time frame, but extension is 6 months at a time. Just like third-party payment you have understood in the case of exports, likewise in the case of imports, there is a similar policy. Tri-party agreement, bona fide transaction. The bank has to make sure that it is a bona fide transaction, and which is a very broad term. So bank will make sure that there is no malafide intention while undertaking the third-party payment. In case of advance remittance, that is also allowed. Extension and write-off is also allowed. Extension and write-off here, what exactly is extension and write-off? So AD Bank shall give extension for submission of the bill of entry beyond the time prescribed frame in terms of the extent guidelines on the matter, and the same will be reported in the IDPMS system as to the message bill of entry extension. AD Bank can consider the closure of the bill of entry in the IDPMS system and which involves write-off to an extent of 5% of the invoice value. In cases where the amount declared in the bill of entry varies from the actual remittance due to the operational reasons. Operational reason means quality concern. The discussion between the two parties which happened was something else. The product was delivered something else. So if in case there's some kind of operational issues, then in that case, 5% is allowed. 5% write-off is allowed. 5% write-off means, for example, I have to make a remittance of, for example, $1 lakh. 5% of it, that is $5,000, I can give a maximum write-off. If I have to go for above that write-off, I have to take the permission from the RBI. In the case of exports, it was till 10% by the bank. Above 10%, it was with the AD Bank. Above 10%, it was with the RBI. Till 10% with the AD Bank. 5% till 5% it was with the self. Here, 5% is allowed self, but the reason should be a operation reason. Next is a very important terminology called as merchanting trade. Merchanting trade, what exactly is merchanting trade? Merchanting trade means a transaction which has happened between two Indian entities of product which, no, basically I'll just repeat or basically reframe the whole example. What exactly is merchanting trade? Merchanting trade is basically, for example, I'm sitting here in India. I want to do certain kind of trading activity wherein I have to purchase a particular product. I can purchase a particular product from China. I can directly, without undergoing any kind of manufacturing, I can sell that product from China to, for example, USA, without entering into a US market, into an Indian market. So directly by sitting here in India, I am selling a product from China to USA without entering into the Delhi, India market. It's called as merchanting trade. So it is very much prevalent in India. For example, I want to do a trading activity, I purchase from someone and directly sold it to someone in India. It is very much allowed. But in the case of exports, it is regulated. So what exactly is the regulation? What exactly is the restriction for the government or the RBI? First is, it should not enter the DTA market. As soon as it enters the DTA market, it will be called as import transaction. Here, the import and export leg, that is the procurement as well as the exports, it should not happen and the product should not reach the Indian land borders. Otherwise, what will happen once it reaches the Indian land borders and cross the land borders of India, automatically it will reflect in my IDPMS and EDPMS system, then it has to be knocked off because it has ultimately either knocked off or then it has to be an import and then export activity. There will be two separate activities. Here, it will be a totally formed as merchanting trade, where the product should not enter the DTA. The bank should make sure that it is a bona fide transaction. It should be routed through a single AD Bank. The total outlay of my foreign exchange should not be more than 4 months. That means I have to make certain kind of advance for the import transaction, but my remittance for the exports will be maybe in the case of 5 months, 6 months. So what they are saying is my outlay of the foreign exchange should not be more than 4 months. And the overall transaction of import and export should be within the 9 months time frame. So this is a specific regulation which is there in the case of import and export activity. In the case of merchanting trade, that means everything should be undertaken within the 9 months. 4 months should be the time frame within which there shouldn't be much outlay of the foreign exchange. Single AD bank should be involved. The bank should be satisfied that the transaction is bona fide. The bank will permit only the transactions which is permitted by the foreign trade policy. That means if a particular product is prohibited under the foreign trade policy, or a person cannot undertake the import or export activity of the specific product because it falls under the prohibited category, then in that case I cannot do the merchanting trade. This is the major regulation or a restriction which is provided by the government, because here the condition is that, and what generally happens is, for example, export of sugar from India is restricted. I cannot export from India sugar as it is without taking the permission from the government. So or the prohibition from the government. So now the question arises: by sitting in India, I cannot do the activity of exports from India. So what I will do is I can procure from the for example, I have the order. So what I'll be doing is I'll be directly procuring from, for example, Africa, directly selling it to the buyer sitting in USA. So it will be called as merchanting trade. It is not coming into India because it is not under because it is under prohibited category. I'm not routing it through India. I'm directly selling it from the buying country and to the consuming country. So this was the major prevalent thing which every consumer or every entity in India was doing. So that is why a specific clause has been introduced which says that goods which are permitted for export and import can only be routed through the merchanting trade transaction. So this was a major part from the angle on the regulation side from the so any questions till now? Otherwise, I'll move to the next part on the other angles which are there for the import and export activity. So next angle is on the export incentives. So when we were discussing on when, for example, when I'm exported outside India, I have not realized the whole amount. And because I have not realized the whole amount, I have to write off. When I'm writing it off, I've taken certain kind of incentives from the government of India. So now the question arises, or difficulty arises, is I've exported, realization is less. So what I have to do with the export incentives? I have to give back to the government of India with interest the proportionate amount of the export incentives which is there. So what all are the basically, I'll just brief it out in the next 10 to 15 minutes on what all are the export incentives. The major export incentive is the road tax scheme. So road tax scheme is basically remission of duties and taxes on export product. What is exactly road tax scheme? When exporting a product from India, for example, I'm exporting laptops. In that case, the government has clearly specified for the exports. For the export of product, the government will give a certain percentage as an incentive or as a refund back to the entity. The refund is basically in the form of a duty credit script. It is a script which the government of India is giving to the exporter. So it is on the basis of the percentage of the FOB value. For example, in the case of just give an example. In the case of laptop, it is 1%. So for example, if I have exported 1 crore rupees of value of exports, 1% of it, that is 1 lakh rupees, I will be given as an incentive by the government of India for exporting the 1 crore rupees of laptops. So this is a road tax scheme. The government is giving a benefit to the exporter community. So why did they are giving? The government wants to reimburse the taxes, duties, and levies, which is levied by the central sales or local level, which is not refunded back under any mechanism by the government of India. So in case, for example, GST, I've exported, automatically what I'll be doing is I'll be applying for the GST refund. Here, it is not the case. There are certain kind of taxes, for example, electricity duty, mandi tax. these taxes are the tax which are inherent in our like production capacity, but is not being refunded back, but is not being given back in the form of a refund to the exporter. So what they're doing is, as a lump sum amount, or as the all India, you can take it as an industry rate. What they have defined is, for each and every product, they have defined a specific HSN, for every HSN code, they have defined a percentage of the incentive. Maybe it can be 1%, 2%, or 4% percentage on the FOB value. You will be given a duty credit scrip. Scrip can be used for the payment of the custom duty. This is the basically the road tax scheme is the government is giving. Next scheme is called as drawback. Drawback is basically a scheme under which it is basically when you're exporting from India, automatically, when you're exporting from India, for example, you exported 1 crore rupees of value of exports. Automatically, for example, 2% is the drawback value. 2% is the duty drawback which the government is giving under the duty drawback scheme. So it will be whenever you are filing the shipping bill, filing of the shipping bill accounts for the application for the duty drawback. Without even realizing, automatically in your bank account, the government will issue a scroll and will issue the duty drawback to your bank account. There is no issue of the script. It will be automatically, it will be in your bank account. So this is called as duty drawback. Next is advance authorization. Advance authorization is basically a scheme under which duty-free import of raw material is allowed. That means what you will be doing is importing the raw materials for the production of the finished product. The finished product is exported outside India. So the raw material which is used for the production of the finished product, which is exported outside India, the raw material can be imported duty-free. Duty-free means no levy of duty. GST, cess, BCD, any kind, no levy of duty. So it will be duty-free import of inputs with the condition that you have to go for export of the finished product. And also a very important condition, that is, there has to be a 15% value addition. That means, for example, I've imported a product of 100 rupees. I've sold the product at, for example, 110 rupees. Can I take the advantage of the advance authorization scheme? No. There has to be a value addition of minimum 15%. Then only you can avail the benefit of the advance authorization scheme. Next question arises, how will you determine that for the manufacturing of the finished product, what are the inputs that is required? So in that case, what can happen is, the government has given certain kind of standard input-output norms. That is standard input-output norms. The government has defined, for the production of this output, standard input is required. So for example, for the manufacturing of this coat, this much dhaga is required, this much color is required. So government has clearly specified that for the manufacturing of particular product, this much input is required. Now the next question is, is it for all the products? No, only for specific products, because there are numerous products, and for each and every day the new product is generated in India or manufactured in India. So here, in that case, you have to apply for the fixation of the norms. That means when you are filing for the application for the advance authorization, you have to apply for the fixation of the norms. The norms committee will define, yes, the technical members of the team, they will define, yes, for this manufacturing, you require this specific inputs. As I was mentioning, there has to be a minimum time frame, minimum value addition of 15%. The time period which is there is, for the case of imported, is 12 months. In the case of exported, is 18 months. It means when I have taken the advance authorization, within the 12 months time frame, I have to import. Within that 18 months time frame, I have to export. There is a possibility of extension of the export obligation period with 6 months, 2 times. So what are the exemptions which is available? BCD, cess, IGST, anti-dumping, safeguard, any kind of duty which is there. In the case of imports, you are allowed for exemption. Duty drawback I already explained much in details. Next is the EPCG scheme. So what exactly is EPCG scheme? EPCG scheme talks about because India is still called as a developing nation, we still talk about that we are dependent on the labor affordability. Our capital is still not the capital intensive like project is still less. Labor, because of the affordable labor, we are able to manufacture different products. For example, government sector is majorly dependent on the labor. The labor cost in India is very less in comparison to the European market. So that is why Indian government sector has been given certain kind of boost because of the affordable labor. But the concern that happened was that labor is already, in comparison to other countries, it is affordable. But what about the capital goods? So India is looking towards towards a frame where they can see on how this specific capital intensive manufacturing is undertaken. So in that case, what happens is government is given different kind of benefits. So major benefit is provided under the EPC scheme, and the scheme talks about and you can import the capital goods duty free. The IGST, BCD, cess, anti-dumping, all kind of duty is exempted. But what is the condition? The condition that is there is that you have to export 6 times the duty saved amount in 6 years. So whatever exports that you have undertaken, whatever duty that you have saved, 6 times of it in the next 6 years, the exporter has to do it. Apart from it, this is a specific obligation. Apart from it, average obligation also has to be undertaken. Average obligation means that in the previous 3 years, financial years, whatever exports you are already undertaken, you should be undertaking it, and you should continue to undertake it. In addition to that average, you have to export 6 times the duty saved amount. So this is called as EPCG scheme. These are the basically the products which is under the negative list. Example: cable, railway wagons, tractors, trucks, motor cars, airport ground handling equipments, furniture, construction equipments, all construction materials, computer and printers, all second-hand capital goods like captive plants and power generators of any kind for export of electric energy or power. So under specific products, you cannot avail the EPCG scheme. As I've clearly specified, specific obligation is there, that is there is 6 times the duty saved amount in 6 years. Average is whatever you are exporting in the previous 3 years, you have to continue exporting. As I have specified, 6 years, you have to complete the whole obligation. If you can do it in the 3 years time frame, the export obligation which is there for 6 times, it will be 4 times. If in case you are fulfilling the green technology, or you are manufacturing in northeastern area, automatically rather than 6 times, it is 4 times. So these are basically the export EPC scheme which is there, under which the government is given different kind of export incentives. Now next question arises is, can I take benefit of advanced license, EPC scheme, duty drawback, road tax simultaneously? No. There are certain kind of restrictions. What are the restrictions? Restrictions are, earlier the policy was that you can take advanced license and duty drawback simultaneously. You can take duty drawback and road tax simultaneously, but you cannot take advanced license and road tax simultaneously. What they have changed is a minor change. Basically, they can be called it as a big change also. If you are availing a road tax benefit, you can avail the advanced authorization benefit too. But the road tax benefit which is there, for example, for generic exports, for example, it is 1%. If you are availing the benefit of advanced, if you are mentioning the shipping bill and you're taking into account on the advanced authorization side too, then in that case, the road tax benefit will be reduced. There is a specific list which is there in this regard. So when you are exporting, shipping bill is filed, road tax benefit will be available, EPCG advanced license benefit will be available, duty drawback benefit will be available, and also EPCG benefit will be available. So all the 4 simultaneous benefit is available. Advanced license benefit will be available at a reduced cost. And basically, road tax benefit will be available at a reduced percentage. Advanced license, you have already availed the benefit, that is duty free import of raw materials. You are just completing the export obligation, because on the account of export obligation, you can avail the benefit of EPCG also. So this is basically the EPCG scheme. In case of green technology, in case of northeastern states, there will be reduction in the export obligation time frame. Third party export is also allowed. That means, what exactly is third party exports? Basically there are 2 parts to it. One is third party payment. third-party payment is basically I've exported to someone, I'm getting the realization from someone else. It is called as third-party payment. In case of third-party exports, third-party export means I'm the manufacturer, but I don't have the export order. For example, someone in my known has the export order. So what I'll be doing is I'll be called as a manufacturer. He will be called as exporter. There will be a third party export. It will be called as third party export. And using my manufactured product, the product will be exported outside India. So how will I get to know that the product was manufactured by me? So in my shipping bill, I have to specify who was the manufacturer, manufacturer address and everything. So third party export is also allowed under the EPC scheme. So there is a minute difference in case of numerology, that third party exports and third party exports and third party exports and third party payment. So here there is a small difference, but it is creating a very different change in the regulations. Third party export is I don't have the export order. I am using, for example, someone else resources or basically someone else marketing ability to export the product outside India. Third party exports. Third party payment is I exported to someone, but getting the reaction from someone else. So another thing is called as ex status holder. So this will be my last topic because we are already it's already 6:50. So this will be last topic. In the last, you'll be taking certain kind of questions with someone else. So status holder is basically because the government wants to give certain kind of privileges or preferences to the community of the exporters from India. So what they're doing is they are giving certain kind of status. Status are divided into 5 parts: 1, 2, 3, 4, 5 status holder, star export householder. According to their export performance, if they have undertaken export performance of value in the current and 3 financial years and 3 years, 3, for example, around 3 US million dollars, then in that case you will be termed as 1-star export house. It is below between 3 to 15, then you will be termed as second 2-star, 3-star for that 50 to 15, 50 to 200 4-star, 200 to 800 5-star. So this is on the basis of export performance. You will be given a certificate by the government of India that you have a certain kind of status. You have a certain kind of star on you, that you are basically an asset for the government of India. So when the government is giving certain kind of asset to you and considering you an asset, government is giving you certain kind of privileges. Privileges can be a faster clearance at the customs, input of norms is fixed in 60 days time frame, exemption from the bank guarantee, exemption from the compulsory negotiation of the documents. So different regulations, which is benefits which are there under the status holder schemes. Deemed exports, I will be not going into detail, just briefing it out. Deemed exporters are basically exports where the product doesn't cross the boundary of India. Deemed export is selling it within the boundary of India. So what supply is termed as deemed exports? When I'm supplying certain goods against an advance authorization, against an EPCG, supply of goods to EOU, SCPI, ESCB, BTP. So these all are covered under the deemed export category. Next is on the free trade agreements. I'll just brief it out as I was mentioning on the free trade agreements. This specific stricter rules of origin, which I was clearly specifying during my initial discussion. What is happening with the government of India signing different trade agreements, and what they have seen is all the trade agreements which the government of India signed, they are in their loss. Their export has not increased in such fashion, but their import has increased. In that case, their import is increasing, but their export has not increased in the similar lines of their imports. So what the government has realized, that they have to tweak the the free trade agreements. So what they have realized, that there were different kind of manipulation that was happening. And the major manipulation that was happening was, for example, India and Vietnam has a trade agreement. So what was happening? A particular product was manufactured in China, routed through Vietnam into India. Because of this routing, the Indian importer was able to enjoy the benefit of the duty-free import because it was originated in the country of Vietnam, with which India has a trade agreement. So what they have introduced, what the government has introduced, has introduced are Carota rules. Carota rules are basically rules of origin. When a particular product will be termed as originated from that specific country, they are specified. Each and every agreement has a different, like for example, instruments or basically the regulations. In certain case, there is a validation criteria that there has to be a 40% validation, there has to be 35% validation in the specific country. For example, in the case of UAE and India trade agreement, it is clearly specified that at least 40% validation has to be there. Then only the particular product will be termed as originated from that country. Otherwise, it will not be. Then only you will be able to enjoy the benefit of the trade agreement. Otherwise, you will not be. So, rules of origin is under the stricter mindset. Introduction of the Carota rules is is that it is the responsibility of the importer. Importer has to give, or basically the importer is liable if and to prove that how this specific product was originated in that specific country. So this is all basically on the free trade agreement side. These are all the trade agreements which the Indian government has signed. 13 other trade agreements, which are bilateral trade agreements between the two countries. Regional trade agreement means the trade agreements which is with different with not specific individual country, but multiple countries in India, like India, Asian countries, India, Mercosur, SAFTA agreement. Recently, which I was talking about, it was EFTA agreement, EFTA India agreement. So trade agreements are divided into bilateral or regional trade agreements. So this was the introduction under Section 28 DA, where the government is providing different restrictions on the rule of origin. So this was all from my side on the import and export transactions. My objective for the today's session was to make sure or to give a holistic guidelines on what all things have to be taken into consideration when when we are guiding a client which is into the import or export activity. So what all things we have to take into consideration, what all acts which are there, for example, FEMA Act, FDRA Act, Customs Act, GST Act, SEZ Act if it is routed through SEZ. So what are acts which are governing the international trade, and deep diving into it, how come these acts are basically impacting the importer and exporter. Either their role can be on the advisory side or issuing a CA certificate in case of write-off, or in case of in different kind of incentive which is provided under the different foreign trade policy. So these are the major scopes which is also available with the professionals like us, like chartered accountants, where we can give a guidance to all our fellow like CAs as well as our clients. So this was all from my side. Any questions from any of the participants, you can ask me right now, or otherwise we can like end the session. Abhishek ji, if, you can see if there is any questions. Otherwise, we can, as you can guide how we should proceed.
Yeah, just a moment. I'll just check. There are a few questions, Manas. I'll just read it for the members, so that you can answer on those. So one of the member, Mr. Sandeep, he's asking, hi, can we have some old intercompany payables pre-IMDPS period? This is partially for imports of goods and partially for services. Can we write back with the waiver condition from the counterparty? Is it compulsory for us to have the pre-approval from RBI and
Yes.
AD banker?
RBI, it is not possible with the permission of the AD bank. You have to approach the RBI in this specific case. Then only it will be write-off.
Okay. So one more question. Petroleum is being proposed to be substitute as with ethanol. Any comments on that?
That is also giving advantage to India for the substitution of the imports. With this advantage, we are able to control our import shipment of crude oil, but still the dependency on the crude oil is very significant. So that is why in the next near future, I'm not able to foresee when we will be a trade surplus country.
Yeah. Mr. Prashant refers to your example of Vostro settlement account. He's asking, I have exported, then why would I pay in INR? I will revolve right is the question. I will receive the same.
So basically, the regulation, I think you have not understood it rightly. When I'm exporting a product, I have to get the remittance in the foreign exchange. It is mandatory. But for some specific countries, there is a specific agreement between India and that specific country, in which you can settle that exports in Indian rupees. That means you can get the realization of the specific exports in Indian rupees. That is allowed only through the Vostro accounts. For example, if I give you an example of Russia, in case of Russia, I have exported a certain product to Russia. I have to get the remittance in the foreign exchange. The issue is with Russia is they don't have the foreign exchange reserves, so they're not able to pay in the foreign exchange. There are different kind of sanctions which is there with the Russian countries. So what they can do is they can settle that specific exports in Indian rupees. That means I will get the realization of that exports in Indian rupees. Otherwise, it was not allowed. I have to get the realization in the freely convertible currency. But in the specific cases, it is allowed under the Indian rupees. But here, a Vostro account has to be opened by the Russian bank. So a Sabar bank has a Vostro account with the Yes Bank in India. So all the transaction will be routed through the Sabar bank with the Yes Bank permission, and you can get the realization in Indian rupees.
Okay, great. So I'll take two more questions for the want of time. One interesting question is being asked on whether subsidiary in India, the goods are imported by Indian subsidiary from a vendor based in Germany. The invoice is in the name of the Indian company, but the payment to vendor was done by the parent company based in USA. Whether Indian company is required to pay to the parent company, and if yes, any specific approvals are required.
So
You got the question?
Yes, I've got the question.
Yeah.
I'll just repeat the question again, what I've understood. So there is a subsidiary in India with a holding company, for example, in Germany. So,
right.
I've exported some like certain products, and the remittance, for example, it can be.
Indian company has imported.
I've imported certain products, but the remittance, I'm not making the remittance. The remittance is made by my holding company to that directly to that company. That is the question.
Yeah. So payment has been made by the US company to the Germany.
And I'm not making the payment because it is my holding company. Directly it is being routed through the holding company.
Yeah.
So this specific transaction is not allowed by under the FEMA Act. Here, if you are importing a product, you have to export. You have to make the remittance. It is not the case that directly from the foreign company this remittance is routed. Opposite is the case. For example, I'm adding this specific question. For example, I'm giving an example. I'm exporting to someone, and the remittance I received from India For example, I'm giving an example. Abhishek ji has given me an order and mentioned to me that export this order to Dubai and I will give you the remittance. This is also not allowed under the FEMA. If you are exporting, you have to get the realization in the foreign currency. If you are importing, you have to make the remittance. It is not the case that the holding company can make the remittance or holding company is involved in this specific transaction. It is also in the case of exports and in case of imports, both the case.
Yeah, Manas, just for the interest of the members, can you just tell what would be the penalty and what would be the legal action can be taken in such cases? Because when it is noticed by the auditor, the transaction must have happened, and at that time, because 15 CACB will also not have been required at that time, so no one will be like stopping the transaction as a consultant.
So why it's a concern? I'll give you background to it. For example, I've undertaken an import of goods. Automatically, it will be reflected in the IDPMS system. When it is reflected in the IDPMS system, I have to reach to the bank within the 6 months time frame to make the payment. But I have not reached to the bank. That specific entry will not be knocked off. It will be pending in the IDPMS system. The concern will be after 6 months, the bank will come to me and why you're not making the payment. After you will go into the extension, till the maximum extension is 3 years. What will we do after 3 years? You cannot tell to the bank that the remittance is already made. Why this specific restriction is there? Restriction is there because what will happen if this restriction is not there? There will be like Hawala transaction will happen. Everything will be settled in Indian rupees. Everything will be settled in the cash transaction. Either through that, I'll be arranging some certain kind of cash and it will be routed through the different countries and reaching to the specific seller. So the specific FEMA Act clearly specifies if you are importing, make the payment. If you're exporting, get the remittance. If you're not, 3 times the amount involved is the penalty.
Yeah, that is what. Yeah.
And there is another procedure called as compounding of the offense. Compounding of the offense is allowed only if you set right the transaction. Here, because you have already undertaken the transaction, the payment is already made. The transaction cannot be set right. So you have to give the penalty amounting of 3 times the amount involved. That is the penalty which is there. So this is a very big penalty which is levied under the FEMA Act.
Yeah. So I'll take the last question and then maybe we'll conclude.
Okay, sir.
Few of the members have given suggestion. They're also like asking us to conduct a seminar on documentation, the requirement thing. Also various when it is from the perspective of CHAs, then listing the documents that also can be taken. So definitely the committee will take this ahead. Mr. Dogi would like to ask a question that son transfers money to transfer US dollars from US to his father in India, like by wire, and crediting this money to his father's account at a conversion rate applicable on the date of credit, but does not specify any charges. But later he informs that by email the deemed supply and the amount of GST charged, but it states that dollar purchase rate is lesser than the dollar selling rate. The difference in the purchase and selling rates are treated as a value of supply. Why such difference in the purchase and sales is not treated as value of supply and different value is stated in the value of supply? So it is like a tricky question. So it is a difference.
So basically, so all the acts are with a different thought process. So for example, the FEMA Act, it talks about on the regulation side. When I'm exporting a product, I have to get the remittance. For example, I exported up one example, give an example, $100,000 of exports. I have to get the remittance in $100,000. There are certain instances where you have realized not $100,000, but 99,985. The reason was 15 rupees was because of certain kind of foreign exchange fluctuation, or it can be because of differences, or it can be because of certain kind of bank charges, certain kind of agency charges which is involved in the transaction, in that case itself, there is no concern. The bank automatically regularizes the transaction. Bank knock off the entry in the EDPMS system. But if there is a huge fluctuation, then in that case, there is a certain kind of issues. The FEMA Act clearly specifies on this angle. GST Act has a totally different opinion on it. Like other acts, Customs Act has a totally different opinion on it. So my thought process on the FEMA Act will be there will be no constraint on in this angle where you have received and the differences is very less, then there will be no certain kind of issues.
Okay, that's really great. Yeah, thank you, Manas. It was indeed a wonderful session. You covered everything. You covered WTO relating to the. You also covered a lot of perspective about the exports volume of India, the countries which we are exporting. You in detail covered the details for the and requirements of the export and imports in India. I'm sure the committee, I'm sure all the members would have benefited from the immense knowledge which has been shared by CA Manas. And on behalf of the committee, I would like to thank CA Manas for taking out his invaluable time and giving us the and sharing the information about exports and imports in India and under the compliance required for FEMA. So we heartily thank you, Manas, once again on behalf of the committee. We also thank all the participant members who are present here for the webinar. We appreciate you attended the session, and we would also like to share your feedback. If you can share the feedback to the committee as you have shared. So we have also noted the sessions which can be lined up in future. It will be conveyed to the concerned persons in the committee, and based on that, we will take a lot of other sessions also. So with this, thank you. We will end the session right now, and we hope to see you for our further initiatives during coming days. So
thank you, participants, all the participants for joining in patient hearing. Thank you, Abhishek.
Thank you.
Thank you for the committee for organizing this.
Yeah.
Okay, thank you, everyone. Thank you.